After a period of relative calm in financial markets, investors have been hit with bouts of volatility in recent weeks. Joining us now to discuss whether this bumpy ride is set to continue is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, always a pleasure to have you back on the program.
It's great to be here.
I was looking through some of the work coming out of your shop over the summer because, of course, that first bout sort of hit us in August. September, it hit us again. We did go through a period of relative calm. Couldn't stay calm forever.
No, it's true. And we got to start on your intro on the way in here. What? NVIDIA is seeking demand? Yeah. Who knew?
Yeah, like that wasn't new information.
Market must go up. Oh my gosh, I didn't see that coming. It gives you a little bit of highlight of really what some of the speculative engine between some of the movement that we're seeing, and I think that actually isn't a bad intro into the kind of the volatility story, and so if we go backwards a little bit, is that every quarter we publish our strategy quarterly, which is this big thought piece of we think what's going on, and that quarter we call it All Is Quiet with a question mark. And the good news is, we published it, I think it was July 29th, and it was, let's look at equity markets and let's look at bond markets and currency markets. In particular, we said, there has been some bond market volatility the last few years, of course, and that had quieted down. But we said, look, if you look at equity market volatility, it's in the lows of 1993. It's in an area that is nearly unprecedented. And currency markets volatility very similar to that, and our All Is Quiet is thinking about this, going, well, really? I mean, how do we shape that? How do you shape that out and think about this in terms of, the market's concerned enough about that all the money is flowing to a handful of growth names, concerned that growth isn't going to come from other areas of the market, like flowing into the NVIDIAs of the world, and if you sat back and said, okay, and so we also have in a 3-week period, not to go through because this is all kind of old news, but an assassination attempt of a former president of the United States, a sitting president of the United States that did a debate that shocked the world, that his inability to build the string of thought and an answer together to a question. And then within a few weeks after that was replaced for the major political party with a new candidate for the president to run for and of course and so if you look at all those and you said there's no volatility,
it's a busy summer.
It's a busy summer, and and so lo and behold, indeed it really picked up at its height. We saw the VIX go up to 65, and the neat part is what we did in our PSQ is we actually mapped out saying this is what it would look like when it elevates again, and it was within that zone. And on the other side is well, we saw the carry trade unraveling in Japan. We saw the Nikkei down 12%. Now, what I'm going through all this is that what happened there, as one could argue, is just to say we got basically somewhere between 3 to 6 months of volatility just packed into a few days.
Yeah, right? On summer vacation for some of us.
Yeah, and so part of that is that summer vacation. It is the lack of liquidity in the system, which is helping drive that. So if you get moves, they can exaggerate those moves, and I think there was some of that as well. But I think that if I'm an investor, and I think I'm looking back and I think I brought a chart along, and I'm not sure if we've got it.
I think so. Yeah, I think we show the audience. So what are we looking at here? Where are we?
And so where are we? All we're looking at here is of course, on looking into, it says Jan 22, but if you go further out, you're looking at 2024, and what you're seeing is the kind of the depths of the VIX way down, the kind of the depths of currency, and you see bond market. You see the bond market, which is move in orange, is elevated a little bit. And all we're showing here is the movement upwards of all of them and more activity in those three. And I think that's really important for what we're talking about here, in that first and foremost is that in a strategist, which I am, and an allocator, an asset allocation portfolio manager, the key is to think about volatility to people like me is like earnings to an equity analyst. It is the big thing, because one, you want to manage those and the downsides, but you also want to capture the upside with it. And so I think as investors, what we have to look at is first is the most important piece is that I think people see volatility and think, oh, it's dire, right? I think you have to step back and you have to look at it and go, first of all, it was a changing of the unemployment rate in the United States that by 1 percentage point, okay? That this was a market looking for an excuse to correct. And it was going to be something. So our commentary wrote about it, of course, was like striking a match on a tinder dry forest. Now, from here, what I want investors to look at is to go, what we're starting to move into the middle of here is actually equity markets and fixed income markets and currency markets and commodity markets actually starting to normalize. Actually going through the process of saying, you're not going to just be asleep, you're not going to have any exchange of going on and just everyone focused on one thing, is that a lot of what you and I are going to talk about today isn't just AI. We're going to talk about the business cycle. Where are we in that business cycle? What's happening in those? And ultimately, what does that mean for currency markets and commodities markets and equity markets? And that's really a breath of fresh air, quite frankly. And so we think that elevation you're going to see, we think we're going to start seeing more of that, but in a positive way, in that we're starting to focus on the things we should be focused on again.
You talk about the labor market. Where are we in the business cycle? As humans, we want to put a story, a narrative around the moves we're seeing in the market. One of the stories that have been attached to the volatility is like, oh no, what if the United States is slowing too quick? What if we're heading for a hard landing? What's the call there?
Right. So I think there's a really interesting one too, and you know the consensus call is that there's going to be a soft landing, and of course, you know, what you want to be in doing what I do is you want to be off consensus and say, well, we think, but it's a pretty compelling case. And so I think that's your starting point of it. I think you want to look at it in these terms. And I think I brought. I think we have another picture. I think I've got a picture. I think that does, because I think this really does help. Now, what we're looking at here is we're looking at the economic cycle, but we're looking at the economic cycle through the lens of the quantitative work that we do globally. So we look at it and we take Canada, the United States, and Japan, and the Eurozone. And we look at hard and soft data. And so the stuff that you get from going out and phoning and asking somebody, how do you feel about something, to looking at something of what are your sales and what does that look like, right? And first of all, I think the interesting part of here is that you can see that in early stage cycle, when we were showing this in the first quarter of this year, China was in an early stage economy, and that's still true. And I want us to remember that they're in an early stage economy, and they are having a heck of a time getting things going again. And one of the things that we said at the beginning of this year, so we eat some humble pie, is we thought, we knew it was going to be a difficult year for China. We thought they were going to be able to do, at least on an incremental basis, be able to work their way through some of this. Because we follow an adaptive approach to doing things, we'd be in the camp, you know what, all bets are off. We know about the long-term structural problems that are in place. The near-term structural problems are continuing to be a huge headwind there. The other point of what we're looking at is at the rate of change of this. So Canada, which was kind of like getting into that later stage, has started to slow more than the other three, and really quite quickly. Now we're in the camp that'd be a soft landing here too, but you're also doing a kind of what's your odds on your outcomes. There's a lot more odds that it could become something more sinister than you would if you compared it to the United States, which is also experiencing a slowdown. But that slowdown it's going through is that all things are pointing to a soft landing. And so the key to this, and one thing I know that you and I have talked a lot about on last times I was here, is that there is an enormous amount of focus on unemployment. And the reason for that is a couplefold. Number one is central banks basically have two main things they're here to do: manage inflation and manage unemployment. If push comes to shove, the things that's most important to them, unemployment is, because you keep people working, inflation too. Now, if we looked over here, we could reasonably do a discussion today and not talk about inflation once, right? If even want,
the market feels like that's behind us now.
Right?
We figured it out.
So the only place in the world where the only place where that discussion's going on are in presidential debates right now, that apparently there is runaway roaring inflation, right? And I know both candidates, and when they're doing that, they know it isn't true, right? So if you put that aside, unemployment is the thing you're going to watch. And unemployment is for us, we're saying it's the thing, even for the global economy, that because China is in a difficult spot, often you want to kind of spread your risks around, which you still do, but also you want to see different drivers at this. The main driver of global equity markets, global fixed income markets now is the U.S., period. Second one of that is the U.S. What's going to happen in the labor market there is the main thing that's going to call the day. And we have been writing and showing this deterioration of that labor market for months now, and said this is what we think is going to transpire. But we're still talking about a fully employed population, and that its slowdown, we think, is a slowdown that's very manageable. We think that you'll see more prints that will be showing that. But at the end of the day, if you look at the other side of the coin, which that leads to the consumer slowing down as well, and we're seeing that. It's being done at a rate as desired. And you don't want to be doing any victory laps here on this. But if I am Jerome Powell, I'm feeling pretty good about this. And
where was the pain, right? They said at the outset, listen, we're going to hike rates, we're going to bring inflation down. There's going to be a lot of pain in the labor market and the economy.
Absolutely,
Didn't happen.
It hasn't happened, and so that's and you can double down on that now on looking at it in terms when comes out in Jackson Hole and says like, look, we've got this road to 2% inflation. We're well on our way here. We're going to be dropping rates, and they're watching. That's the thing they've got circled now. And, I confess, we spend an enormous amount of time thinking about that and looking at this. I think they're in pretty good shape. It's going to get worse, but I think you could reasonably see that this soft landing is well in place there.